I'm Gary Shilling. I'm president of Gary Shilling and Company. We're economic consultants and investment advisors. Well, I'm known for looking for bubbles.
Oh, I think we're headed for a recession.
I think that housing is going to see a substantial price decline.
Housing is starting to fall apart.
I've had reasonably good luck in spotting him. I was probably the only economist on Wall Street who saw the big inventory build up in the early 70s that led to the 73-75 recession, which up to that time was the most severe on record. I've been known probably the best for having said in 1981 we're entering the bond rally of a lifetime when Treasury bond yielded 14.6%, the 30-year bond. Well, I also was pretty lucky in the housing bubble. Starting in 2002, we saw what we thought was an emerging bubble and followed it on up, and then correctly forecasted demise. And incidentally, it paid off very handsomely for me and my clients. You don't add any value by rehashing the consensus. That's already discounted. It's fully worked into markets. As somebody who has made a career out of spotting bubbles, I don't see anything right now that's really begging for that. There are some possibilities. One of them is what's happening in emerging markets. These countries feasted on cheap debt after the Great Recession. It was readily available. Foreign investors were throwing money at them. They thought to get much better returns there. And they borrowed a lot, particularly in dollars. Well, guess what's happened now? The dollar has gone up. So it costs them more in their local currencies to service those dollar debts. And also, the imported raw materials. You had a big problem with emerging markets in the late 90s. There was contagion, and that's the real risk, but it didn't sink the world ship. Debt in the U.S., as long as I've been in this business, there's been this constant harping about the size of government debt, and our grandchildren are going to have to pay it off, and the whole country is going to sink. That may happen someday. I would say this, that if you look at debt, you got to look at it not in dollars. You got to look at it in a denominator. You got to look at it in terms of GDP. After World War II, it was 135%. It got down to about 60%. Now it's 80-some%. Now that doesn't mean I'm no fan of debt. But we did some work on that, and we said, what would it take in terms of interest on the debt? 8%. Now it's a little over 2%. Now, how would you get to 8%? You'd have to have either rampant inflation, and interest rates tend to go right up with inflation, or a complete loss of faith in the federal government. And if that were the latter were the case, obviously you want to get your AK-47s and dried food and bottled water and crawl into a cave. I just don't think that's the case. Bull markets and stocks and long runs and expansions in economies don't die of old age. There's a reason, and there are two of them that, at least in history, have been the case. One is the Fed jacks up rates to the point that they kill the economy. Now, the Fed never starts off saying, we're going to kill the economy, we want this baby to go down the tubes. No. They just want to cool off what they think is an overheating economy, or one that may get that way, and that's where they are now. By my count, they've tried 13 times in the post-World War II period to do that, to cool it off, but in 12 of the 13 times they got a recession. The only soft landing, in effect, where they did not have a recession, the economy just slowed down a bit, was in the mid-90s. The other cause of recessions are shocks, financial shocks. And that's what we had, as I mentioned earlier, with the dot-com blow-off in the late 90s and the subprime mortgage collapse in the mid-2000s. Yeah, I would say that's more likely that the Fed ends up precipitating the next recession. Matter of fact, in portfolios we're basically short stocks because I think we are seeing in the stock market sell out perhaps the last hurrah, and the stock market is a very good leading indicator of the economy. So maybe that's another reason it's telling us that a recession is not too far ahead.